Gold tumbles nearly 10% in a single week, marking its worst performance in 15 years. What's next for the once glittering asset? Investors are left questioning whether this is a temporary dip or a signal of a more prolonged downturn. Welcome to Profit and Peril, where we cut through the noise to deliver market-moving news. Today we're diving into gold's dramatic decline. This isn't just a blip, it's a seismic shift that could have ripple effects across global markets. While this is not financial advice, understanding the forces at play is crucial for anyone invested in precious metals or considering entering the market. Gold crossed an unprecedented $5,000 per ounce in January, driven by a confluence of factors including inflation hedging and central bank buying. The metal was seen as a safe haven amid global uncertainty, attracting both institutional and retail investors. However, it's now trading under $4,600, reflecting a nearly 10% drop this week, the steepest since the financial crisis of 2008. The primary drivers of this decline are rising Treasury yields and a strengthening US dollar. As yields offer higher returns, investors are shifting their portfolios, reducing their gold holdings. Furthermore, the dollar's strength makes gold more expensive for foreign buyers, dampening demand. The situation is exacerbated by the Federal Reserve's continued signals of interest rate hikes, which could further elevate yields. Let's break down the numbers. Gold's price action has been volatile, characterized by sharp daily fluctuations. Candlestick patterns over the past week reveal significant bearish trends, with consecutive red candles illustrating investor anxiety. The SPDR Gold Shares is down 3.6%, reflecting broader market sentiment. In contrast, the iShares Gold Trust shows a 50% return over the past year, primarily due to its strategic asset allocations and lower expense ratio. However, can it maintain this momentum? Historical data suggests that while gold often rebounds after corrections, the current macroeconomic environment presents unique challenges. Gold's allure as a safe haven is under scrutiny. Traditionally, gold's value has been driven by its role as a hedge against inflation and currency devaluation. The metal's recent peak of $5,600 in January was bolstered by geopolitical tensions, including the US and Israel's strike on Iran, which heightened global uncertainty. However, as central banks stabilize and inflation fears wane, gold faces renewed pressure. The iShares Gold Trust, IAU, offers a cost-efficient investment option with an annual expense ratio of 0.25% compared to the SPDR Gold Shares, GLD, with 0.40%. Yet these ETFs' performance is not solely tied to expense ratios. The broader economic context, specifically the interplay between monetary policy and market sentiment, plays a crucial role. As Treasury yields rise, driven by expectations of further rate hikes, the opportunity cost of holding non-yielding assets like gold increases. Additionally, a stronger dollar makes gold more expensive for international buyers, further reducing demand. This double-edged sword of rising yields and a robust dollar threatens gold's stability. Investors must also consider the potential for renewed geopolitical tensions, which could disrupt markets and shift sentiment back towards gold. The current environment is a delicate balancing act between market forces and investor psychology, with gold caught in the crossfire. Comparing gold's performance to other sectors, it's clear there's a divergence. While technology and energy stocks have surged, driven by innovation and rising global demand, gold is lagging. Sector heat maps reveal this trend, with tech and oil sectors awash in green, signaling growth and investor confidence. In contrast, gold's section appears starkly red, indicative of its recent struggles. This divergence highlights a shift in investor focus towards growth-oriented sectors, which offer higher potential returns in the current economic climate. Here's the urgent risk. Gold's decline could accelerate if the dollar continues its ascent. A stronger dollar means less demand for gold as a hedge, particularly in emerging markets where currency values are more volatile. Moreover, geopolitical tensions, while currently subdued, may flare again, adding volatility to already fragile markets. The $70.6 billion in GLD assets could see significant outflows if investors lose confidence, leading to a self-reinforcing cycle of selling pressure. Additionally, if central banks decide to reduce their gold reserves in response to changing economic conditions, it could further exacerbate the decline. Investors should also be wary of potential market overreactions, where panic selling could push prices even lower, creating opportunities for long-term investors, but posing significant risks for short-term traders. Looking ahead, gold's path is uncertain but not bleak. While current challenges persist, any significant market correction or geopolitical event could quickly reignite interest in this enduring asset. Despite recent declines, gold remains about 8% higher this year, underscoring its resilience in times of economic instability. For investors, the key is to weigh gold's historic allure as a store of value against the dynamic forces shaping current market dynamics. Diversification remains crucial, and gold may still play a vital role in a balanced investment strategy, particularly for those concerned about long-term inflation or currency devaluation. So, is gold a profit or peril? Given the current dynamics, gold seems to be leaning towards peril in the short term. However, it retains its status as a long-term hedge against inflation and uncertainty. Investors should remain vigilant, keeping an eye on macroeconomic indicators and geopolitical developments that could impact gold's trajectory. In the end, understanding the complex interplay of market forces and maintaining a diversified portfolio will be key to navigating this volatile landscape. If you found this analysis valuable, hit subscribe and ring the notification bell for more insights. Stay informed, stay ahead. By joining our community, you'll gain access to timely updates and expert analysis to help you make informed investment decisions.